Running from God's creations, shaking these broken hands and meeting with blank faces. Snake eyes keeping my back aching. Dirty habits of rapping and being.
Hello, welcome to the new episode in Forex Trading Mistakes. It's taken me quite a while to get this video out and make it in the first place because I've been quite busy making the website. Hopefully you've seen it, busy with students, etc. So this has kind of had to take a back seat. But I am back now, and this new video is on journaling. So the importance of journaling your trades. Now, a mistake that a lot of people will make, new and experienced, is not keeping a journal. So the mistake itself is just not having a journal, basically, and not realizing how important it can be. So this video is going to detail basically why a journal can really help you improve and can be your best friend sort of thing through your journey of trading. So jumping straight in, we'll look at two different traders at two very different ends of the scale. So to begin with, we have Trader A. Now Trader A, he's a new trader. Maybe he's just started or he's been trading for a few months or learning. He's read Technical Analysis for Dummies. He's read Trading in the Zone, of course. So he thinks he's George Soros and he's ready to smash the markets. We know how that turns out. And Trader B, he's an experienced trader. He's been trading for a few years maybe. He's doing quite well, he's consistently profitable, and maybe he's got a Porsche. If he's an Instagram trader, then anything's possible, as we know. So what do they both have in common? Well, Trader A and Trader B, although very, very different in terms of their abilities and their actual trading, they both have room to improve their trading. So although one of them has just started and one of them is consistently profitable, both of them can still improve. So neither of them have reached the glass ceiling. The ceiling keeps going upwards. No matter how good you are, you can still get better. So if we fast forward a few months, Trader A, the new trader, well, things haven't gone so well for him. So what he thought was going to be brilliant and great didn't turn out to be so great. And things haven't gone so well, so he now goes away and looks for the next best strategy or the next best indicator, the holy grail sort of thing. So he's not too happy. He's looking for a way to make back what he's lost, maybe. He's looking for the next best thing. And Trader B, the experienced guy, well, he's in the same place. He's still making profit. He's consistently profitable. But he's pretty complacent. He's happy where he is. And you might think, well, fair enough. He's making profit. That's fine. Which I suppose is true. But we'll look first as to what is this next best strategy or the next best indicator for Trader A. So what is this next best indicator, best strategy, or kind of holy grail sort of thing? Now, it's not an indicator that you put on your MT4 or TradingView. It's not a strategy from this guy or the next guy. The next best thing is a journal, because nothing else is going to tell you what you're doing wrong, and nothing else is able to identify your mistakes better than a journal, because the journal is your trades. Like, this is what you're doing. So you can look back over the trades you've taken over a period of time, and you can identify kind of common themes, common mistakes you're making, and find ways to improve on those things, which most of the time is kind of just not doing them. But otherwise, if you don't have a journal, then how are you ever going to know what you're doing wrong? Because everyone knows that, if you keep doing something wrong and you don't journal it down, you don't note it down because you don't want to admit it to yourself or whatever, then you're never going to improve because you're never going to fix it. But if it's written down on paper or on Word, then you can actually look back and see exactly what you've done wrong with trade examples, images, before and after shots, which is what I'll go over next as to how to lay it out and how to do it properly. So if you're Trader A and you're kind of new and you want to find out why your trades are losing or why you're not winning very much, while you're losing more than you're winning, etc., then what you want to do is just have a journal, because that's going to tell you what you're doing wrong. You can look back over it and you can kind of cross-reference all your trades, etc., and see really where it is you're going wrong and identify those common mistakes that you keep making, which could be pretty much anything. Now with Trader B, with the experienced trader, obviously he's not in that same position. He's not losing money consistently. He's a consistently profitable trader. But what he's looking to do with the journal is really kind of find out a way where when he does lose, he can lose less from those losers, and when he does win, how he can win more from those winners. So, you can always improve your trades, get better entries, better exits, better profit targets, etc., etc. Find out which strategy you use is the best, which currency pair you're the best on. There's a whole host of things you can use a journal for, and it's really not just as simple as just what you're doing wrong. There's so much more you can use it for. So no matter how good you are, or how good you think you are, a journal is still something you should do every time you take a trade. So let's go forwards and look now at my journal and how I do mine, and kind of how you should also lay yours out and what you should include in your journal. So this is my trading journal template that I use. I've uploaded this to my website, so it's free to download. You can go to my site, go to the free materials page, and you can download it there. It's called Trading Journal Template. It's a Word document, so you can use it on Word or with any other editor. So this is what I use every time that I take a trade. So I'll fill everything on this page in. You may think it's a lot of information, but it really means that you can go back at any point and really see everything about this trade. There's nothing kind of left ambiguous. Everything that I need to know in the future possibly about this trade or after it's been taken, I have that here. So I'll go through step by step as to everything that I've written down and why I've written it down and kind of why it's useful. So to begin with, we have the currency pair that I've bought or sold, and whether I've bought or sold it. So I'll put the currency pair in there, delete the buy or sell that I don't use. If I buy it, I'll just delete the sell. Put the date down. Of course, the date's important, so you can look back in the future on the charts and have a look at what the trade was about. Next up, we have this little section here. So X% just means the percentage of my account that I risk. I always stick to 1%, so this always stays at 1. And plus minus XR just means the risk-adjusted return for the trade. You can find out what that means in my risk management document. Again, it's free. Go to the site, it's the risk management guide. So plus minus XR, so that just means if I made a one-to-one trade and it won, then that would be plus 1R, because I risked 1%, so I made one risk back basically, so plus 1R. E for entry, so the exact pip that I entered. Stop loss, the exact pip that I would have got out. And TP, the take profit, the exact pip I would have taken my profit out. Quite simple stuff. So, and all this allows you to go back and really look at exactly what you did if you want to look back in the future. Next up, we have the before shot. So of course, all this text is great, but you want to visually see the trade you took. So you take the before shot before you enter the trade, and this allows you to have a look at what the market was like before you entered without the kind of noise afterwards, if you were to look back in the future. So yeah, take a photograph in TradingView, easy to do, put it in here, and that's your before shot. Again, have your profit and loss tool, your kind of entry tool there, so you can visually see where your targets are, where your stops are, where your entry was. So next, your actual entry criteria. So here you're going to want to put exactly why you entered, and don't be kind of scared to put too much detail. Go into as much detail as you can to really remind yourself, because in a couple of weeks' time or so, you probably forgot exactly why you entered. So this is why you should have this part. It's very important. You can see your exact reasons, your mindset at the time as to why you thought this was a good trade. So, you should kind of have about 3 confluences for a trade. You shouldn't really be taking trades just based off one thing. I mean, that's subjective, but that's just kind of what I say. So, of course, you want to state why you entered and the confluences you had to enter, why you placed your stop where you did, and why you placed your profit target where you did. So the kind of logic behind why you did that. After that, we have the after shot. So you take this shot, of course, once the trade has either hit your target or hit your stop, and this allows you to again visually see what happened on the chart without all the noise afterwards of going back and looking at it just on the chart. So you can see here, this was actually a pretty good trade. So my top one, my before shot, I took it before I entered. After, hit my take profit, so I took the shot again. And I don't have my entry for this trade, the reasons, because this is just a template, but you can see how you could lay this out in your own way with the trades that you take. And this is kind of the most important part really, and also can be the hardest part for some people. So the exit is the most important thing, whether it hit your stop or your target, trailed stop or whatever. In this section you really have to be very truthful to yourself, because of course if the trade lost, then you kind of want to find excuses as to why it lost. Maybe it's, because the brokers are out to get you or any of that bullshit. But actually, most of the time, it's because of something you've done wrong. So you have to be truthful to yourself, say exactly what happened in the trade, and you have to evaluate what you did. Basically, your trade must be evaluated to the best of your ability, really. So how you could have improved your entry, improved your stop placement, your profit placement, or whatever. If you made a really obvious mistake, this could be pretty much anything, but if you made an obvious mistake that you can really see, then make sure to put it down. Don't be scared to kind of face it. Note it down, so the next trade you take, just make sure you don't make that mistake again. So write down the mistake you made, look back when you enter the trade, say, right, make sure I don't make this mistake, and that should help you to eliminate kind of bad habits, etc. A really important thing to remember is that a perfect technical setup, so a trade that's like, brilliant technically, can still lose. There's no 100% certainty at all. So if that is the case and that you can't find a fault with your trade, don't kind of spend ages trying to find something wrong with it. If nothing was wrong with it and it's a good trade, then just, that's fair enough, that happens. So just say it was well executed, it was well, the technicals were well thought out, just didn't hit profit, so it's fine. You don't have to go on and try and find things that went wrong in a trade that was fine. So just, don't try and fault yourself, basically, if there's no need to. Just say it was good and move on. So going back to our two traders, after they've started doing their journals and they've stuck to it and they've done it properly. So trader A there with his trading journal, so he's now able to identify his common mistakes that he's making. He's able to improve on those mistakes. He's able to figure out ways where he can enter trades better, exit better, all those sorts of things. So he's now figuring out his own trading style, basically, and being able to look back and see where he's going wrong and where he's going right. Trader B, our experienced trader, he's still doing well, like he was before. If you can imagine, this is his equity curve before. He's consistently profitable, but now he's got his trading journal and he's able to improve yet again. Maybe he's able to improve his equity curve a bit more, so now he's even more profitable. He's making more from his winners and less from his losers, losing less from his losers. So these two traders, they're now in a better place. It takes some work to do. Obviously, a trading journal doesn't take 2 seconds. You have to put some effort into it, and it's a bit of kind of back office admin work. But if you're treating trading properly and you're treating it like a business, like you should, instead of just like a hobby, then this really is what you should be doing every single time you take a trade. Don't skimp on it. Do it properly, and you will notice a difference, because you can see, you can kind of figure out yourself. Basically, you figure out your own trading patterns and how you can get better. So that's all for that episode. I hope it helps a lot of people. And you can go to my website, rubenblameyfx.com. It's brand new. You can go to the free materials section and find the Trading with Trendlines guide. You can find the trading journal template to download. You can see my other free content. Lots of information on there. So you can also email me with any questions, rb.fx@outlook.com. And Instagram is where I do most of my stuff, at rubenblameyfx. So until the next time, goodbye, and hopefully this was a big help.